Gold just dropped massively from its all-time high. It went from record levels to a steep decline in a matter of weeks. A brutal correction. Gone, just like that. And the question everyone is asking right now is simple. Why? Is gold falling when the world is literally on fire? There's a war in the Middle East. The Strait of Hormuz is effectively shut down. The national debt is at record highs and climbing every single day. Central banks are buying gold like their survival depends on it, and yet, gold is falling. If that makes no sense to you, good, because it shouldn't. And if you stay with me for the next few minutes, I'm going to show you exactly what's happening behind the scenes, why this pullback is not what it looks like, and why history says what comes next could be one of the most explosive moves in gold we've ever seen. Let's get into it. Right now, if you're a gold investor, you're in pain. You watched gold rocket to record highs. You were told it was going much higher. And now, you're watching your portfolio bleed. The mainstream financial media is calling it a correction. Some are calling it the start of a bear market. They're saying gold's recent plunge marks a dramatic shift in investor sentiment. And the worst part? You're watching the dollar rally at the same time. The US dollar is on track to record its strongest monthly gain in years, as escalating tensions surrounding the Iran conflict drove a sharp shift in global capital flows towards safe haven assets. So you're thinking, wait, gold is supposed to be the safe haven. Why is the dollar getting the safe haven bid instead of gold? Why is everything I was told about gold wrong? Here's what most people miss. It's not wrong. You're just looking at the wrong time frame. And you're confusing a short-term liquidity event with a long-term structural collapse. They are not the same thing. But that's only the surface explanation. The real mechanism is this, and I'm going to walk you through it step by step. Step 1. The Iran-US conflict created massive Middle Eastern instability. The Strait of Hormuz closure disrupted global energy transportation. Oil prices spiked. That sent shockwaves through every market on Earth. Step 2. When oil spikes, inflation expectations spike with it. Rising oil prices and a string of firm inflation readings pushed rate cut expectations down to almost nothing. So the Federal Reserve, which had been expected to cut rates multiple times this year, is now frozen. The Fed voted to keep the benchmark rate unchanged. Step 3. When rate cut expectations collapse, the dollar surges. The dollar index rallied sharply from its recent lows. The Hormuz closure, elevated oil prices, and a Fed on hold are all genuine supports. And when the dollar surges, it creates a massive headwind for gold in the short term. Step 4. And this is where everything changes. When markets panic and oil spikes and stocks fall, there's a scramble for cash. Investors sell what they can, including gold, to meet margin calls, raise liquidity, and cover losses elsewhere. Gold doesn't fall because people don't want it. Gold falls because people need cash. This is the mechanism that confuses almost everyone. Gold selling during a crisis isn't a signal that gold is broken. It's a signal that the crisis is so severe that even the best assets get liquidated first. And guess what? History shows this pattern again and again. Let me take you back. During the global financial crisis, gold dropped sharply in the months before the most aggressive money printing campaign in history. What happened after? Gold rallied to record highs within a few years. The people who sold the dip missed a massive multi-year move. When COVID hit, gold dropped violently in just 2 weeks as markets melted down. Everyone needed cash. Gold was sold alongside everything else. What happened after? Gold surged past its previous highs within months. And here's one most people forget. After gold was legalized for American citizens to own, it actually fell dramatically over the next couple of years. People thought the gold era was over. But it was just the beginning. Gold then rallied to levels nobody thought possible by the end of that decade. The pattern is always the same. Panic liquidation, cash crunch, gold sells off. Then the very conditions that caused the panic, the debt, the money printing, the currency debasement, the geopolitical chaos, those are the conditions that send gold parabolic in the next phase. So the question isn't whether gold is falling. The question is, what structural conditions are in place right now? And this is where this time isn't just different. This time is significantly more dangerous. Let's start with the debt. The gross national debt of the United States has reached record levels. Relative to 1 year ago, the total has climbed by trillions more. That's an increase of billions per day. Federal debt as a share of the economy is projected to keep climbing for the foreseeable future. And here's the part that should keep you up at night. A massive chunk of every dollar the government spends now goes just to pay interest on the debt. Not to pay down the debt, just the interest. This is not a problem that's getting better. This is a problem that's compounding. And historically, when governments reach this kind of fiscal trap, there are only two ways out. Either they default, which for the United States means the end of the global financial system, or they inflate the debt away, which means they print money, which means the purchasing power of your dollars falls, which means hard assets like gold go through the roof. Now layer on top of that what central banks around the world are doing, not what they're saying, what they're doing. Official sector demand remains resilient, with forecasts showing central banks will purchase massive amounts of gold this year, almost the same as last year. China has been buying gold consistently for over a year and has lifted its gold reserves to a significant share of total reserves. The broadening of demand from central bankers might be an emerging key theme going forward. Both Malaysian and Korean central banks have resumed interest in increasing gold exposure after prolonged absences. Think about what that means. The most powerful financial institutions on Earth, the people who print the money, are choosing to trade their own paper currency for physical gold. They are telling you, with their actions, exactly what they think about the future of fiat money. These institutions are now buying gold to ensure sovereign autonomy rather than simply trading the price action. Central bank purchases remain well above the historical average seen before recent years. And here's the crucial detail. When a central bank adds physical bullion to its vaults, that supply is effectively removed from the liquid market for the long term. This creates a tightening effect that supports higher valuation floors regardless of short-term interest rate volatility. The supply is shrinking while the structural demand is accelerating. That's not a bearish setup. That's the setup for a breakout of historic proportions. Now let me walk you through what happens next, because this is where it gets really interesting. Phase 1 is happening right now. The liquidity crunch, the war premium in the dollar, the oil shock causing inflation fears, rate cut expectations being pushed back, gold selling off as speculative money exits. Phase 2 comes when the economic damage from higher oil prices and frozen monetary policy starts showing up in the real economy. The Fed has already revised its growth forecast sharply lower. Job creation is stalling, consumer confidence is fragile. The economy is slowing into a potential stagflationary environment. Phase 3 is when the Fed blinks. And they always blink. When the economy weakens enough, when the labor market deteriorates enough, when the financial stress becomes too great, they will cut rates. Major investment banks still see room for normalization cuts, although their timing remains dependent on the length of the conflict. Once the conflict premium fades and the Fed resumes cutting, institutional forecasts expect the dollar to fall significantly by year-end. And when the dollar weakens and rates come down, that's when the rocket fuel hits gold. Phase 4 is the breakout, and the biggest banks on Wall Street are already telling you where they think gold is going. JP Morgan, UBS, Wells Fargo, all of them have targets far above current levels. Some strategists argue gains could extend even further in an upside scenario, citing mounting geopolitical tensions. From current levels, those targets imply massive upside, and those are the conservative estimates. So what should you be watching? Here are the key indicators that will tell you the breakout is starting. First, watch the dollar index. The DXY has been in a long downtrend from its recent peak, dropped to a low, and has now bounced sharply. If the dollar rolls over from this level, that's one of the most powerful tailwinds gold can get. Any sign of Middle East de-escalation will immediately deflate the dollar's war premium. Second, watch the Fed's language. Right now they're in wait-and-see mode. The Fed says uncertainty about the economic outlook remains elevated, and the implications of developments in the Middle East for the U.S. economy are uncertain. The moment the language shifts from inflation concern to growth concern, that's when rate cuts come back on the table. Third, watch central bank buying data. Are we seeing a steady floor of broad-based buying, or a narrower story with one or two buyers dominating? If the buying base continues to broaden, as it already is, that's a structural floor under gold that speculative selling cannot break for long. Fourth, watch real yields, not nominal yields, real yields. That means the actual return on treasury bonds after you subtract inflation. With energy-driven inflation potentially pushing consumer prices significantly higher, real interest rates may remain negative or barely positive despite nominal rate holds. Negative real yields are the single most bullish fundamental condition for gold, and we may already be there. Here's the bottom line. Gold is not falling because the bull case is broken. Gold is falling because we're in the middle of a liquidity event driven by a geopolitical shock. The war in the Middle East, the oil spike, the dollar surge, the Fed freeze. These are all short-term forces pressing down on gold. But underneath all of that, the structural picture has never been stronger. The debt is at record highs and growing by billions every single day. Central banks are buying gold at the fastest sustained pace in modern history. The Federal Reserve is trapped between a weakening economy and stubborn inflation. The global monetary system is fragmenting. Every single one of those forces ultimately pushes gold higher, not lower, higher. Analysts have noted gold had traded well above its long-term moving average before this correction, a level that historically triggers profit-taking. Their view is that the correction was healthy, and the underlying drivers of the rally remain intact. This is the dip that history will remember. The question is, will you be positioned for what comes after, or will you be the one looking back wishing you had paid attention? The pattern has played out in every major crisis of the past several decades. Every time, the crowd sold the panic, and the patient investors captured the breakout. This time, the stakes are higher. The debt is bigger. The geopolitical risks are more severe, and the structural demand from central banks is unprecedented. The setup is not just similar to those past moments, it's more extreme. Gold is not done, it's reloading. If you want more deep market analysis like this, subscribe and stay close to the channel. Because what happens next in gold, in the dollar, and in the global economy over the coming months could reshape portfolios for a generation. Don't miss it.